Today on Disruptive Investing, we're going to be talking about crowdfunding.
Yeah, we got a lot of questions about this, and we're going to walk you through what crowdfunding is, how it works, and how you as an investor may be able to include these early stage companies in your portfolio.
Now, you've probably heard of crowdfunding before, something like an Indiegogo, Kickstarter, or GoFundMe. This is not the kind of crowdfunding we're talking about today.
Right. Indiegogo, Kickstarter, and GoFundMe do not offer equity in exchange for your money. Most of the time, there's little promise that you'll even end up with a product that you signed up for.
This channel is Disruptive Investing. We're interested in investing, and today we're going to be talking about crowdfund investing. Okay, so to make this whole thing a little bit more fun to talk about, let's pretend that we have been working out in the garage on a new product. It's a robotic banana smoothie machine.
It's looking really promising. It has some cool tech, and it can make a smoothie faster, cheaper, and better than the competition.
It cost us like $2,000 so far in parts to make this machine, and now we have a barely working prototype, basically a proof of concept.
It's not pretty, but it works sometimes, and it has some of the functions that we want.
We spent a few grand more on lawyers to incorporate a Delaware C Corp, and so Jesse and I and you are now the three shareholders in Banana.
That's our company, Banana, but of course it's spelled with only one A at the end. So B-N-N-A, hip. All right, so this is exciting. I mean, we have a company and I'm the CTO.
Congratulations.
Let's go. Let's get listed on NASDAQ so people can invest in us on Robinhood.
Okay, well, hang on there, fella. We don't even have enough money to get this prototype painted, let alone even think of making revenue yet.
I mean, if we can't make revenue and we can't sell shares on Robinhood, then how are we even going to survive?
Exactly. We need some money. In fact, we did some math and we figure we need about $100,000 to make a presentable prototype and buy some much needed equipment.
And don't forget, I'm the CTO, so I need a big fat paycheck.
No. We're putting in sweat equity at the moment.
No paycheck, and we need $100,000. How is this supposed to work?
Well, for many startups at this stage, it's called friends and family.
That doesn't sound very sexy.
It's not. It's a lot like begging.
What about banks?
Well, you tell me of a bank that will loan three people in a garage $100,000 with no assets and no revenue.
But we have a great idea.
Have you even patented it yet?
That's a good idea. Let's do that.
Yeah, that costs thousands of dollars that we don't have right now.
Couldn't I put up my house as a collateral?
Sure, and many startups do that. But that means that if we are like one of the many startups that fail, the bank will take your house. Is that what you'd like to do?
I guess I'll call my grandmother.
And I'll call my brother-in-law.
But wait, what are we giving them in return for their hard-earned money?
We're giving them shares in our company.
But you just said that we couldn't use Robinhood. How do we give them shares?
Yeah, we're a private company, but we still have shares, and so we're going to have to value the company and strike a deal on how many shares they'll each get for their investment.
Wait, do I have to give up some of my shares?
Yep, all three of us are going to have to give up some of our ownership of the company to our new shareholders.
But we're founders. We should all own a third of the company.
That's just not going to be possible if we need to raise money. Investors only invest if there's something in it for them. That's why Indiegogo and Kickstarter are so attractive to many startups, because they aren't giving up ownership. They are just having customers prepay for new products.
Great, so let's do that.
Okay, we could. Many companies do. But what we're trying to make is more complicated than a comic book or a backpack. Our machine is probably going to take at least a year and many iterations before we get something that works and looks good, let alone all of the manufacturing so that we can mass produce enough of them to sell at a reasonable price and still make a profit. We have no background in this, so it would be a tough sell.
Okay, yep, I'll visit. Absolutely. Thank you so much. Love you. Okay, bye. All right, so Nana is getting 10% of the company. Now we have our $100,000. What's next?
So we have some money to file for our patent, the self-cleaning tubular retraction mechanism that only our machine will have. And now we have enough money to buy that CNC machine and CAD software so we can continue iterating.
Am I getting paid yet?
No. All right, it's been a year. And we are now almost out of money, but we have a really good looking prototype and a website, and we're getting some interest from prospective customers.
Great. Let's start selling, because that'll make revenue, and then I'll be able to get paid because I'm the CTO.
Hang on there, Mr. CTO. We have no money left for manufacturing, let alone your salary.
Crap. Does this mean that we go bankrupt?
No, it means we need another funding round.
But that was all the money Nana had. In fact, she's been calling me a lot.
All right, well, now we have some options. We can approach some venture capital firms and show them our pitch deck and our product video of you drinking a banana smoothie.
Great. I've watched Silicon Valley. I'll bet that we can raise an easy $1 million.
Well, our projections do look good, and our product is solid, and I think you're right. We could probably get a VC firm to bite, But you may not like what they want.
What do they want?
They're going to want a big chunk of the company, 2 board seats, and one of the guys has been talking about how he likes strawberry smoothies.
That's bullshit. Banana smoothies are the future. That guy doesn't know shit. I'm not giving half our company to him or his cronies. He has no idea where the future of frozen beverages is. This is my vision, and no one's gonna derail Banana.
Okay. Well, we do have another couple
I got it.
options.
Crowdfunding. I get it now. I'm going to make a video. We'll post it on the internet telling people to invest in our company. That's right. Just send us a check for $30,000 and you'll get equity in Banana, the bananiest smoothie machine on the planet.
Whoa. That's kind of illegal.
What? Isn't that crowdfunding?
No, that's not allowed.
Wait, so people can't take their own hard-earned money and invest it in companies? What about Robinhood? Isn't that what people did with GameStop?
Well, the difference with GameStop being a publicly traded company is that they are regulated by the SEC, the Securities and Exchange Commission. And so everyone knows what their financials look like. So if you want to risk your money, at least you know what you're getting. But our banana company is private. No one outside of us founders has seen our books.
So wait, if someone has a lot of money and they want to invest in us, they can't?
Well, actually, the SEC does allow what they call accredited investors to invest in companies such as ours.
Perfect. Let's find some accredited investors.
Well, it's not as common as you think because to be an accredited investor, you have to have a net worth of over $1 million, excluding your primary residence.
Excluding your house?
Yep, or income of over $200,000 a year for at least 2 years.
Crap, I don't know many of those people. Do we have another option?
Well, we could crowdfund.
That's what I was trying to do.
The SEC has what's called Regulation A, which is an exemption from some of the registration requirements that public companies have to do. And in 2015, Regulation A, or Reg A, was updated to allow companies to raise money under 2 different tiers. Tier 1 allows companies to raise up to $20 million without having to do any ongoing quarterly financial reporting. All they have to do is report once the round is closed. This has become very popular with startups because it only costs about $40,000 or so to file all the paperwork.
But wait, I read that it can cost $50,000 to $100,000 to file for a Reg A.
Right. Filing the paperwork with lawyers costs about $40,000, but that doesn't buy your company any exposure to investors. What you're probably talking about are companies like Start Engine that file the paperwork and put your company on their platform so that potential investors can find you and make it easier for them to invest.
Okay, so let me get this straight. We're going to need to pay up to $100,000 to raise... Well, actually, that's a good question. How much do we need?
Well, we figure we need $3 million to have enough runway.
Runway? We're not making an airplane. We're making a smoothie machine, remember?
No, runway is how much time the money you raise will get you before you run out.
Oh, right. I mean, we need to hire engineers to help us figure out how to mass produce this. Not to mention we need some sort of factory space somewhere and machines to mass produce it. And can I get paid now?
Yes, we're all going to start taking salaries because we've quit our day jobs and this is for real.
Okay, so we need $3 million. Let's get the lawyers to start the paperwork and let's call Start Engine. But wait a minute. What do the crowdfunders get?
They're going to get shares in the company.
Wait, we have to give up more shares? Can't we just make some shares so I can keep mine?
Well, we can...
Yes! Free money!
No. Even if we create more shares, you're still getting diluted.
What? Diluted?
Remember, each of us founders has 2.5 million shares.
Yes!
Nana has 1 million shares, and my brother-in-law has 1.5 million shares.
So let's just make a couple million more and dole them out to the new investors.
Okay, sounds good. But don't forget, that means that instead of you owning 25% of the company, you'll now own 20.8% of the company.
Okay, I mean, for $3 million, I guess I can get behind that.
And that's only if investors think that's a good value. If we don't offer enough, we won't get any investors. It's a really hard thing to value a company that isn't making any money yet.
Yeah, how do we value the company?
It's tough. We have to use projections of what we think is going to happen. And then investors will take a look at our investor deck and evaluate what they think we're worth. You know, what are the chances we'll be successful? And if we are successful in bringing our product to market, how profitable will we be? Keep in mind that most startups fail.
But some go on to be wildly successful. Look at Uber or Airbnb.
Yep. And early stage investors in a company like that can easily 1000x their initial investment. Or I could name dozens of companies that you've probably never heard of because they never made it. And most of those early stage investors never got back a dime.
Okay, but getting back to Banana, which is going to be successful, how much are we selling our shares for?
Well, on this round, let's say that after much discussion, we arrive at a share price of $1.50 per share, and we're selling 2 million shares to raise $3 million.
Woohoo! I have 2.5 million shares. I'm a millionaire. Does this mean that I can start selling some of my shares and buy a boat?
Hang on there, CTO. For one thing, if you sell a lot of shares, investors may get spooked because it doesn't look good for a founder to be selling out this early. Secondly, it's really hard to buy and sell shares in early stage companies. There are exchanges like Carta that do this, but it's not a liquid market like the public stock markets are.
Okay, so let's go public.
Not so fast. There's generally only two ways to go public. The first is to find a big publicly traded company that will bring us public in what's called a SPAC.
Oh, I've heard of that. There's been a lot of those, and most aren't doing that well.
Right, because they generally are bringing companies public that haven't made any profit yet. Many of them haven't even made much revenue.
What's the second way?
Well, we can wait until our company grows and we start making money. If we meet the exchange requirements, we can go public on that exchange and then issue shares to investors called an initial public offering, or IPO.
I assume that's going to take a while?
Yeah, there's a good chance we'll need to have more funding rounds before we even get to that point.
Wait, how can that be? And why would investors keep pouring money into a company before it even makes money?
Well, let's take a look at a company we know and love, Tesla. Tesla was founded in 2003 and had a Series A round in April of 2004, which brought in $7.5 million. It had a B round less than a year later for $13 million, a C round a year after that for another $40 million, and then in 2008, they went public. They weren't even full year profitable until last year, 2021. But if you had invested in one of those early rounds and held onto your shares, you could easily have 1,000x your investment.
Wow. I mean, could someone have crowdfunded in that?
Well, they didn't have crowdfunding like this until 2015.
What?
Yeah.
Wow.
Those are all like private friends of Elon's.
Wow.
And here's a key point to remember. You can only lose 100% of what you invest.
That's awful.
No, it's great, because if you invest, let's say $1,000 in 20 companies and only one of them is successful.
I just lost $19,000.
Yeah, but if that 20th company was Uber, Tesla, Airbnb, SpaceX, you could be now looking at 100x to 1,000x on your investment, which means you're now sitting on $100,000 to $1 million. How do you think venture capital firms make so much money?
We hope that you found this episode on crowdfunding helpful. We know that kind of crowdfunding is this brand new thing in the world. I mean, obviously, you couldn't have crowdfunded in Tesla, which I think we all would have loved to do. And so by talking about banana, we can sort of look at it from the perspective of people who are running these companies,
right,
to see why they're going to need to be crowdfunding and what that means for you, the crowdfunding investor, to say, like, is this something that I wanted to be getting into? And then am I, willing to wait until this company gets all the way to their IPO before I can sell my shares, and that kind of thing. I think there might be more episodes that we can talk about crowdfunding. Let us know if you think you want to talk a little bit more about, share prices and IPOs and stuff like that. I think it could be very important.
I think an important point here, though, is that, never before in history has the SEC allowed us to invest in companies before they went public. They allowed us to do other stupid things like go to the racetrack or go to the casino. But for some reason, they didn't allow us to invest in new companies, even though lots of other rich people in the world have been doing that for decades. Now we kind of leveled the playing field, right? We can get in on early companies the same as all the big boys. Doesn't mean that you should just do that blindly. And that's what we're here for. We're here to interview these new companies so that you can get to know the founders, get to know what they're working on, and see if it sounds like a good investment for you.
Yeah, we cover a lot of startups here on Disruptive Investing, and we're looking to share with you companies that could disrupt the market they're in and make their investors a lot of money.
Join us on our Patreon and consider joining us on our Investor Club, where over 1,000 members are talking every day on our exclusive Slack about investing.
We bring you weekly Investor Club bonus videos, live streams with CEOs and founders, where you get to ask questions directly to them, because ultimately it's your hard work and research that can pay off as an investor.
Thank you so much for watching, everybody. We'll see you next time.